Hello friends, how are you all doing? So it's just 2 days left for the AFM exam, today and tomorrow. So I hope that you are utilizing this time very effectively. So here is part 2 of AFM tools to pass. So these are the 5 main sections, and in this video we are going to cover section C and section D. Section A and section B has been covered in the first part of this video. You can click on the I button on your right side to get to the first part of this video if you haven't watched my first part. So now we are going to proceed with section C, acquisitions and mergers. This is also is a very key topic, right, which you keep getting. But the problem with this section is that the questions are not standard. It could vary, and the answers which you have to provide also varies, right? So that's why acquisition and mergers is you have to work on this section a little bit more, right? So first, the key areas you must cover is first you have to know the benefits and the drawbacks of mergers as an expansion strategy. This is like a theory part, right? Whenever you are given a topic, you are not just given the numerics, you are also given the theory. So you also have to go through the theory of it. The theory could be, so these are the some of the theories which you could be asked. I have mentioned it here. Okay, so first is the benefits and the drawbacks of mergers as an expansion strategy. There are many ways of expanding a business. So mergers and acquisition is one way. You need to know the benefits and the drawbacks. Next we have is the mergers versus internal growth. Why mergers, right? Or why internal growth? Why not mergers? Third, we have types of mergers. What are the types of mergers? You need to know what are the types of mergers, right? So what are the types of mergers? Like we have horizontal mergers, we have vertical mergers, right? Upward, backward. Then we have diversification, conglomerate merger, right? So these are different types of mergers. Horizontal merger, same line in the same line of business, same stage of production. Vertical, backward means you are joining with the supplier, and forward means you're joining with the customer, the retailer. And the conglomerate merger is it's a diversification. It's two different unrelated business. Then we need to know a criteria for choosing an appropriate target for an acquisition. What are the criteria for choosing an appropriate target for acquisition? Why only this company, right? When you go for an acquisition and mergers, don't think there is only just one company, right? There could be many companies which could be an attractive target or a suitable target for your company to merge, right? But out of all, you have to select, you have to shortlist, and you have to select the best one for your objective, right? Objective of your company. Which one is the best target? How do you select? There are some criteria for choosing that, right? And you need to know what are those criteria for choosing an appropriate target for an acquisition. For example, this could be some of the criteria, right? Diversification could be one of the criteria. Maybe you want to diversify into a different line of business, right? It is a business which is different to your business. Maybe your business is not doing well, right? So you want to go and join with some other firm which is in the different line of business compared to you, so that your risk reduces, right? You can spread your risk. Another criteria could be increase the debt capacity, right? You can utilize the debt capacity of that company, your target company, right? Another one could be access to key technology. Maybe your target company is having technology which you don't have access to. So if you target that company, if that company, you acquire that company, you can get access to their key technologies. The other one is control of the company. Maybe you can get the control of the company, access to cash resources, right? Maybe you are lacking in cash. So, or maybe that company is lacking in cash. It could be either way, right? So your company, maybe that company, right? They have all the resources, they have the staff, they have the proper marketing team, everything is done. R&D is also there. The thing is they lack cash, they don't have enough cash resources, but you have cash resources. So when you acquire that company, right, your cash and their skills can be combined and it can create synergies for the company, right? Then tax saving, benefit for acquiring undervalued company, and also the synergies. Synergy is one of the reasons, right? Next, we are coming to that only, synergies. So there are three types of synergies. What are they? You have to know it, right? One is revenue synergy, cost synergy, financial synergy. So these are the three types of synergies, right? Revenue synergies, like you can see if there's an increase in market power, or marketing synergies. These are way of analyzing revenue synergy in your question, right? It depends on what type of synergy is, right? Based on the case study which you're going to get. Revenue synergy in practical, right? It is more harder to quantify than financial and cost synergies, because financial and cost, it's easy. You can see what is the cost, you can see what are the financial benefits. But when it comes to revenue synergy is like you're predicting that in future there will be higher revenues, there will be higher growth to your company, but it takes a longer term. You cannot see the results quickly, you cannot see the results in the short term. That's why revenue synergy, it takes a time and it's hard to quantify, right? Now let's go to the cost synergy. Yes, cost synergy is like economies of scale, right? Because two companies merge, now they can take the advantage of economies of scale, right? And next, third type of synergy is the financial synergy. What does it say? Financial synergy, tax benefit, or the use of cash, or diversification to reduce risk, or debt capacity could be increased. So these are the types of financial synergies, right? You can even write it down while I'm speaking the points, or you can just go through your textbook and it's there. Everything is there in your textbook. This everything I've summarized and I'm trying to explain you the key points which you have to cover. And the third reason is reasons why accusation fail. Even if all these things are there, right? It's an appropriate target, synergies are there, still there are reasons why accusations fail. You need to know the reasons why accusations fail. One such example, let me tell you. Okay, let me tell you a few examples why accusation could fail, and you could write it down while I'm explaining the points. One is errors in valuing a target firm. There could be errors, right? You might be valuing a target firm very high or very low. If you are valuing a target firm very high, you are paying high, right, accusation cost to purchase it. In fact, when you later come to know that it's actually the value is much less, but you have paid more, right? Another reason could be agency theory. What does agency theory talks about? Agency theory talks about that management might want to acquire for their own self-interest. It might not enhance the shareholders' wealth, right? It might not maximize the shareholders' wealth, but they care about their diversification. The managements want to diversify their own portfolio, right? So for that reason, if it's from management self-interest, what they want to do, they, even if they know that it's not in the benefit of the shareholder, right, they will do anything to take over that company, because they know they have their self-interest. Even if that accusation is not going to benefit the company in the long run, they don't care, they are going to acquire it, right? Then comes the market irrationality, preemptive theory, right? Poor integration management, there could be integration problem. Maybe they're inflexible, or the management of the two companies, their culture might be different, or they're inflexible to work together. And also window dressing, right? When you see the financial statements and when you see the results, the financial results of the target company, they might be manipulated. It could be manipulated. You might have seen the manipulated results and you thought of acquiring the company. So this is the some of the reasons why accusations might fail. Next, let's go to more details, such as reverse takeovers, right? What is reverse takeovers? Heard of this term? What is reverse takeover? So these are the things which have not been appeared in your exam previously when you see the past paper, but these are the things I predict might come for your exam, so you should always be prepared for such terms. Reverse takeover. What is reverse takeover? Reverse takeover is where a small quoted company, okay, just mark my words, small quoted company takes over a larger unquoted company. It's like a share for share exchange, right? Smaller quoted company, right, is taking over a larger unquoted company. So what's happening? What is happening because of that? The larger company who was unquoted, now they can get a listing in the stock market, right? And they can also be a dominant partner now in a listed company, the larger company. So this could be a method of accusation and also a way of obtaining a stock market listing, right? So that is known as reverse takeovers. Means usually what happens, the big company takes over the small company, right? Here the small company is taking over the big company. In other words, the big company who is unquoted, they are letting themselves to be taken over by the small company, right? They are willingly, they want to be taken over by the small company. Why? Because they want to get a listing on the stock exchange. So it's reversed now, right? Just take takeover. Who takes over? The powerful company takes over the smaller company. The big company takes over a small company, right? Take takeover that way. Reverse is the opposite of that. The small company is taking over the big company now, right? So that is reverse. The role is reversed. That's it. That is only difference. That is the only thing which you have to know about the reverse takeover. It's not much complicated also. You also have to know the advantages and disadvantages, right? There are three advantage and three disadvantage. Quickly, let me go through that. First advantage is speed, right? This could be taken at a very high speed when you compare with IPO, right? What is IPO? Initial public offering. When you take over like that, it could take 1 to 2 years, but reverse takeovers could be done in a matter of months. So it's speed. Cost is also less. Cost is much less in reverse takeover because when you go for fight for an IPO, there is cost to that. Next, third advantage is availability, right? When the economy is not doing well in recession, who wants to go for an IPO? Who wants to go and list themselves? No one. But reverse takeover will even they will be done even that time also. It will not be an issue. But the economy is doing in the downturn, right? If the economy is in downturn also, it will not affect reverse takeover. Still, reverse takeover will happen. The disadvantage is that lack of expertise is there, right? This big company who is unquoted, they have lack of expertise because now they'll be listed, right? Because of reverse takeover, they'll be listed now. So they need to be listed. You also need expertise to run a listed company. It's different. Running a listed company and running an unlisted company is two different things, right? Another disadvantage is risk is there, right? Because as I said, window dressing, it could be manipulated. You don't know. The small company who is quoted might not know about the big companies unquoted. They might have some liabilities which is hidden there from the financial statements. So all these things, investigation is to be done. So it's risky, right? And also the third one is what? Third disadvantage is share price decrease, right? If the shareholders in the listed company sells their shares after the reverse takeover, then this could lead to a drop in share price, right? So all these things are disadvantages. You can even read the ACC article, technical article on reverse takeovers from your ACCA website. Next we have is why overvaluation problem occurs. This is a very important thing, right? I have seen that it has been asked in the past paper, even in March 2020. It has been asked why that it was in some technological industry, I guess, tech, right? Tech industry, why it has been overvalued. So why gives rise to overvaluation problems? There are many reasons to that, and this leads to behavioral finance and overvaluation. Make sure you know behavioral finance, what it is, what are the aspects of it, and overvaluation, right? So these are some behavioral finance. Confirmation bias, you must have heard about this, right? Even in March 2020 we have gone through a question where we explained all this. We have done a whole paper on this. Confirmation bias, what is confirmation bias? From the word confirmation itself, you know, is to be something which is confirmed, right? For example, managers will be paying more attention to evidence that supports their logic, that supports their decision, their opinion. They will not look at those evidence which goes against them. Why? Because they want to confirm that they are right. You can call it overconfidence, you can call it confirmation bias, whatever it is, right? It's known as confirmation bias only. You want to confirm that you are right. Next, loss aversion bias. What is loss aversion bias? See, in any takeover bid, right? More than one company is involved in bidding for a firm. That you have to know. So in this situation, what happens is, it is like a psychological factor, right? That there's a strong desire to possess something because there's a threat of it being taken away from you. For example, you, right? You and your friend goes and you know that you are not going to get it, right? It's like first in, first out. Whoever goes first gets it, grabs it. So you always want to be the first one to take and grab that opportunity. Why? Because you don't want to lose that opportunity. You're always having a fear that what if my friend takes it? Let's say an offer is going on, an iPhone offer is going on, but it's a limited edition only for some time. What will happen? Both you and your friend will be fighting with each other to get it, right? Why? Because you don't want to lose that opportunity. You have a fear of losing it. It's called loss aversion bias. Even if the price is set at high level, very high, still you will go and purchase it. It's like a psychological factor, right? So it's loss aversion bias. Third we have entrapment. What is entrapment? Entrapment is, see, we are always, it's like a trap, right? We are caught in a trap. You can say it like that. It's like a trap. What is the trap? Most of the time, right? Most of the time, you know that you have, what to say? You know that a strategy is failing, right? You know some strategy is failing, but still, you will be unwilling to move away from it. You will be fixed with your decision. You will still go ahead with that decision. Why? Because of your personal commitment, right? You thought maybe it's your idea, right? You have come up with an idea or your personal commitment. So you don't want to give up on that. It's like it will hurt your ego or something. So you will still be with that. Even if it means that you are spending more from your pocket, you don't mind because it's your idea. It's your commitment. You have committed there, right? It's your decision. So you're desperate. It's like you're desperate. You are having this desperate attempt to turn around the failing business. You think that you can turn around the failing business once you have acquired that. So this entrapment can cause prices to rise very rapidly, which means you are paying excessive price to acquire a company, right? Because you think when you acquire a company, you can turn around your failing business and you can turn your failing business to profit making. So it's like a trap. That's why that word entrapment comes. Next we have anchoring, right? What is anchoring? Anchoring is like see, we saw that a decision making may be affected by available information, even if this is not necessarily relevant information. We always react on the information which is very available, which is very recent. Even if it's not relevant, we don't care about the relevance. That is known as anchoring, right? Even if it is very rational, right, doesn't make sense, still you react on the available information. That is anchoring, right? And also it is known as availability bias. That means more prominent information, right? People focus on information that is prominent, available, recent. Then we have this valuation methods, right? So this is the key. Once you know this table properly and you know each method under this, there are total 9 methods, 3 methods under each 3 model. Once you know it, you know how to calculate it, you have nothing to fear about in this chapter. You have covered the whole, what is acquisition and merger section, you have cleared. If you are comfortable in all these 9 methods, if you know how to calculation, I can guarantee tell you that your mergers and acquisition you have done absolutely well. You have covered it, right? Because your whole chapter, whole concept is on this models. Rest all is theory part. Rest all you can mug up. But these things you need to know, right? And these are the things not to be practiced in the last moment. They have to be done in the beginning of your study. When you started your study program, this should have been done that time, not now. So if you are planning to do it now and practice it, it's too late, right? It's too late, dear friends. Don't do that. But yes, you can go through and see how an answer has been covered under each method. Under each method, take up a question from the past paper and see how each method is presented. Don't just be focused on one method only. Let's say PE ratio, right? Price earning ratio. Don't be always with PE ratio. What if the question asked you to calculate APV or CIV or dividend method? You should be comfortable in under any method, because you don't know which model they might ask you, right? You don't have a choice. They will be asking you in this method. They will specify you to use this method, so you should be comfortable in using all the 3 methods. You should know the advantages and limitations of all the models, all the methods. So everything I've summarized in this, right? First I will be starting with asset based model, then market based, then cash based, right? So you can take a picture of this before I proceed to the next slide. Okay, so first under asset based, what we have: book value plus CIV, average. Under market base, we have price earning ratio, earnings yield, market to book ratio. Under cash base, we have dividend, FCF, that is free cash flow to equity, and APV, adjusted present value. Now you see that your whatever you have studied under your dividend valuation model or FCF or FCFE or APV, adjusted present value, before is going to be useful here. There is nothing new in this chapter. Everything what you have studied from before in your section 1 and 2, section A and B, right? Now you have to make use of that knowledge. So make sure that you cover up, you are comfortable with adjusted present value, because you need it here. Even in mergers and acquisition you need it. Even in investment appraisal you need it. Same with FCFE, right? You can need it in your investment appraisal, you need it in your mergers and acquisition. So make sure that you are comfortable with this. Let's start with the asset based model. The first one is book value plus. What is it? Book value plus, it says something, it's like book value, right? So you take the book value and plus. Now what is that plus? We'll come to know, right? Book value plus, whenever you are asked about asset based model and this method is referred to book value plus, your starting point should be from your statement of financial position. You'll be given a statement of financial position, right? So your starting point is from financial position, from your balance sheet, because your asset values are given there only. Asset based model, just see the word asset. That means you have to take your asset value. From where? From where will you get your asset value? From financial statements, financial position, right? So that is your starting point. Next, how are you going to get this? Deduct long-term and short-term liabilities from total assets and get the net asset value. Now, you have to be careful here. Total assets does not include intangible assets. Mind you, I'm again repeating, total assets does not include intangible assets, only tangible assets. Why it does not include intangible assets? Because there's another method. The second method is about intangible assets, which we are going to cover after we cover this method, book value plus. So for that, we have another method, right? So whenever you're given goodwill or intangible assets, don't include with total assets, exclude it. Add only the tangible assets, then deduct both short-term and long-term liabilities and get the net asset value, right? Then use to estimate a minimum value for unquoted company. So this model, asset-based model, this is mostly used for where? For unquoted company, not for quoted company, unquoted company. Why? Because for quoted company, we have better methods like market-based or cash-based. But for unquoted company, asset-based is used the most. Why? Just see unquoted company, right? You cannot use market-based model. Where will you get the EPS? Where will you get the price earnings ratio? This only you will get for the quoted company, listed company. You will never get a price earning ratio, earnings yield, market to book ratio for an unquoted company. So there is no chance of using market-based model for unquoted company. Then let's go to cash-based model, right? Cash-based model, yes, you can use, right? But mostly it is the asset-based model which is used, and the amount which you get, right, for that unquoted, that is minimum value, right? You can estimate the minimum value for that. Next, in liquidation, use realizable value of assets. Yes, whenever there's a liquidation in your case study, when you see that this company is liquidated or something like that, it is better to use the not the book value of assets, not the, what is in the balance sheet. Use the realizable value of assets. This realizable value you might be given. If you are given in the exam, then use the realizable value, because that time you might be in a confusion, right? Whether to use the book value or the realizable value. Use the realizable value of assets in liquidation, right? If no liquidation, then it's perfect book value, right? That also of realizable value is given to you. If it's not given to you, then you can use book value, but I'm sure if liquidation is there, they will obviously give you a realizable value of assets. Next we have book value. Now we'll come to know what is that plus, right? Book value, we all know book value. What is that plus? Okay, so book value of net assets, a starting point for negotiating acquisition price for small company, right? Book value of net assets, right? As a starting point. This is the starting point for what? For negotiating acquisition price for small company, right? Based mostly, why are we valuing this company using asset based, market based, or cash based? Because we want to get an acquisition price, a starting acquisition price. That's why we are finding this valuation of acquisition using asset based, market based, or cash based. First, you have to understand that why are we even valuing that to get the acquisition price? Because based on that value only we can charge an acquisition price. Our acquisition price cannot be less than the value. It should be equal to that or more than that, right? Let's say by using asset based model, your valuation is 500,000. So your acquisition price has to be 500,000 or more than that. It cannot be less than 500,000. Then the target company will not sell that company to you if it's less. That's why we have to do this valuation to get a price, starting price, because we need to negotiate on an acquisition price, right? For small company, plus a premium is book value plus. So that premium is the plus. You are adding a premium to that book value, right? That premium could be anything. It could be 25%, it could be 50%, that you can use anyway. It's up to you. But that premium is known as plus, book value plus. You're adding something to that book value, a premium. That's why it's known as a book value plus. That's why this method is known as book value plus. Otherwise, it could be kept just as book value, right? It's like a margin you are adding to your cost to get a selling price. It's like the same technique. Next, let's go to the second method. I told you don't take intangible in the first method. Why? Because we are taking here CIV. The full form is calculated intangible values. Now, this form of model. Now, you have to be very careful. Each model is not, it's not applicable for all. It's not suited to all kind of business. For example, the first one, book value plus is suited to which type of companies? Small unquoted companies. But this type of this method is suited for established business in the service industry with huge intangibles. If you're having very small amount of intangible, this method is not suitable. Why I'm mentioning this here? Because in the exam, you might be given a question where there might be tangibles or there might not be tangible. They might ask you why this method is suitable or why this method is not suitable. That time you should be in a position to explain why this is suitable or not. That's why I'm explaining you this point here, that why this method is suitable or not. So this method is not suitable for those companies where there's no intangibles at all. Everything is tangible, right? This is suitable for tech industries. Why? Technology like Microsoft, Google. It is suitable for this type of companies. Why? Because when you go and check Microsoft and Google, they have huge amount of assets. Are They are intangibles. Their brand value, their copyright, their staff, their human capital, not their tangible assets, right? Their huge amount, their brand value comes from their intangibles, not from their tangible values. Microsoft, Google, all this tech industry, high tech industries, Amazon, right? So they have, so also this, they are established business, right? Because if you're not established business, of course it makes sense. If you're not established business, you cannot be having a huge intangibles. Intangibles means what? Patent rights, copyrights, trademarks, goodwill, all these things comes over the years. Over the years means you have established, you are like, you are an established business. When you're starting business, right? A starting business cannot be having a new growing business. You cannot expect intangibles from this type of companies. They're new, right? To develop intangibles, it needs time. It's common sense, right? It's nothing finance, but it's from your common sense. When you have to make intangibles, it needs time. All this Microsoft, Google, they spend huge amount of money in R&D, right? Over the years, they have developed this huge amount of intangibles. So that's why it has to be established business in the service industry. So next, so there are some 6 methods, right? I have written all the methods. You can use this method, right? You can use the steps to calculate intangible values, and you have to follow this step in the correct order, in that order only. Step 1, calculate average pre-tax earnings over time period. Average pre-tax earnings means, let's say you are given a 3 years earnings. What you have to do is add the 3 years earnings, divide by 3. That is your averaging, right? Pre-tax, it should be pre-tax, before tax. Don't take tax now into account. Second, step 2, calculate average year-end tangible assets over the time period using statement of financial position. Tangible assets, not intangible assets. Why? Why tangible assets? Because intangible assets, what are we doing? We are finding excess return on tangible assets, the excess return to tangible assets, right? Our values does not just come from tangible assets plus intangible. So that addition we are finding from intangibles, right? Tangible, right? Excess return on tangible assets. So that's why we have to find average of tangible assets over the time period using what? Financial position. Here also same thing. You will be given the tangible assets, values of tangible assets for, let's say, for 3 years. Add all the tangible assets and divide by 3. Step 3, multiply the industry's return on assets by entity's average tangible asset, right? See, industry's return on assets you will be given, right? That percentage, let's say 8%, it will be given to you. So you don't have to worry about it. You just have to take that percentage and multiply by what? Multiply by the step 2, right? Step two's answer. Whatever you have calculated in step 2, you'll be getting an answer. Multiply by that answer, right? Average tangible asset, and subtract this, like you have to minus this figure. After you multiply by step 2 answer, minus this from step 1's answer. That is the pre-tax earnings, average pre-tax earnings, to calculate what excess return. That will be your excess return, right? Step 2's answer multiply by average, multiply by industry's return on assets minus step 1 answer, you will get the excess return. Step 4, now the excess return which you have got in step 3, that was pre-tax. Adjust it for tax. After you adjust it for tax, fifth step is calculate the net present value of premium. How? By dividing after tax excess return by cost of capital. That means step 4, right? That is the adjust excess return for tax. You have to divide it by what? Cost of capital, to calculate the net present value of premium, right? The step 4's answer, you have to divide by cost of capital. Cost of capital will be given, and then you will get the net present value of the premium. Why premium? Premium, in other words, is an excess only, right? Excess to tangible. That's why it's known as premium. So these are the 5 steps you have to follow to calculate intangible values, right? Whenever you are given this method, CIV. Next, we go to the, by the way, the third method, the leverage method. I'm not mentioning here because the leverage knowledge earning method, the third method, and the asset based model is because it is a complicated method and I haven't seen any question from the past paper on this, right? But there's a small section on your page 314 of your BPP textbook. You can go through that and read it, right? So that's why I haven't included here. Otherwise, you will get more confused. I don't want to confuse you. Let's go to the second type of model, that is market-based model. Under market-based model, the first one, the most used method under, even if you see in your past paper, is this PE method, the price earnings ratio method. I think they like this method. I think the examiners, liking this method. They're very familiar. This method is, you must be very familiar with this method. It has been repeated in the exam over and over again. This is the formula I've written down for you. Please take it. Market value. That's what you want to find, right? Market value is equals to earnings of target into your price earnings ratio. Price earnings ratio you might be given directly. Let's say 18 is your price earning ratio, or you might be given indirectly, like you might be given some other ratios and you have to calculate price earning ratios first to find the market value. That also might be possible, right? Earnings of the target. Now, earnings of the target that you have to calculate, the target company's earnings you have to take. If you want to see how we want to calculate earnings of target, please go and check my videos where I've solved an acquisition and mergers question on this from March 2020. There was a question on this earnings of target where I've calculated it using the same method only, right? March 2020 AFM paper. I don't remember the question number, but you can go and check the acquisition and mergers question. It might be, I guess it's the first or the third question. Next we have, right, the point which I mentioned before, need to know how to calculate price earnings ratio if not given directly, right? You might not be given price earning ratio directly, some other ratios, but through that ratio you have to calculate, first you have to calculate PE ratio, then you have to multiply by earnings of target to get the market value. Next. Okay, what does high or low price earnings ratio indicates? This you have to know. Have to know means have to know, right? This method is given. If this method is given to you on the exam, this you clearly have to know what an high or low PE ratio means. If this method right? Even if you don't get this method, like let's say you don't like this method so much and you don't get this method, then it's okay. You don't have to care about high or low PE ratio. But if it's given, then you have to know what's a high or a low ratio indicates mean, right? So you cannot skip that. And also, under all this method which I'm explaining one by one, you need to know the problems, you need to know the benefits of it, you need to know the problems with the method, disadvantages, right? I'm not writing here individually. Advantages are this, disadvantages are this. That's you can do. Like you can go to the textbook and you yourself can find out. Next, should know how to calculate maximum amount that an acquirer should pay to target. This question, whenever an accusation question is given to you, this question, I have never seen a past paper where this question is not mentioned. This question is not given. It's always given under accusation mergers. What is the maximum amount that acquirer should pay to target? In fact, there was a question also, maximum and the minimum amount, right? So if you want to know this, right, on your textbook, chapter 10, page 317, right? The question is on 316 and answer is on 317. Attempt it and see whether you understand this on maximum amount or not. And then if you haven't understood, you can message me, you can DM me on my Insta, on my Facebook page, or you can also email me in my Gmail account, right? Even you can comment me below on my YouTube, on my comment section, right? Next, even this is there in that question, right? Should know how to calculate the minimum amount. See, there's a difference between you might think that it's the same. The maximum amount that a guy should pay will be the same amount that target company shareholder should accept. No, it's not the same thing, right? The minimum amount that the target company shareholder should accept is different. Maximum amount that acquire should pay is different thing. And whenever you are given this question, right, range if asked for will be between the maximum and the minimum, right? Most of the time you might see that they don't ask a specific question, like they don't say maximum or minimum. They say what is the possible range, right? What is a sensible range of values which a bit of this company could be negotiated at that time. They might not ask you what is maximum or minimum. They will just ask what is the range. Suggest a suitable range for the price of this company. That time you have to find the maximum value also, you have to find the minimum value also, and you have to suggest, write this sentence there, that the between this, okay, the amount between maximum and minimum is the range. So this is how your answer should be, right? They might not ask you also to find minimum and maximum, but if they ask for a range, you have to find maximum and minimum, and then say that the amount between this both is the range. Yeah, it's a range. Next, earnings yield. This is the second method under market-based model. Earnings yield, what is it? You need to know the formula of EY, earnings yield. This formula is been given on my part 1 of this video. Like in the first few minutes, I have told you what are the ratios, what are the formulas you need to know, what are the ratios you need to memorize or you need to know before you go to AFM exam. Under that, I also have mentioned earnings yield. So make sure that you know the formula. And there is a second formula to this also. This is this. The surprising thing about earnings yield is this thing. 1 divided by earnings yield is also the PE ratio. So in the exam, you might be given 1 divided by EY, or you might just be given earnings yield. Let's say earnings yield is 10. So what is the price earning ratio? 1 divided by 10, right? 1 divided by 10. That's the PE ratio. So you have to think like this. Don't get stuck anywhere in the exam, right? In this AFM exam, you have no time to get stuck anywhere. If something is not given to you directly, don't break your head. Try to work out and see there might be something there in that question Something which is given indirectly to you, not directly to you. Don't accept everything directly. That is my first request to all of you. Life is never going to be so easy for you, right? If it was that easy, everyone, you would see everyone would be passing ACCA in the first attempt itself. Because we always assume everything to come easy to us. We want everything to be given directly to us, and we just have to feed the information and do number crunching and just feed it. That's not what is. That's not how life is. So please, you might be given indirectly also. Don't break your head. Let's say you want to find price earnings ratio, and that price earning ratio is only not given to you. What happens? Most of the candidate, 95% of you will be breaking your head. But the other 5% of you who are smart enough to get the catch, that no, it's there. It's not given directly, but indirectly through some other ways. So I can convert this and find a price earnings ratio, and then I can get to my answer. So this is how your approach should be in any exam. So if price earnings ratio is not given, check for something else. Some other ratios might be given. Earnings yield is given, dividend is given, market price is given, earnings is, something will be given to you, right? It cannot happen that you are not given anything at all. It will never be like that. Examiner is not a fool, right? So don't think you need to think out of that thing, right? Don't be so comfortable with the easy things. Things might be given in a twisted way, like it might be little twisted and all. So you need to find out. So if EY is given, find PE ratio. If PE ratio method is asked for. Market to book ratio, this is the third method, and it's also an easy method also. Much thing is not required to do under this method. First is, you need to know these two things only under market to book ratio. This ratio is also known as a Q ratio, right? In the exam, they might ask you not market to book, they might ask you find Q ratio. That time you should be able to know that it's they are asking market to book ratio only, market to book or Q ratio. Interchange, they can use any words they want to use, but you should know what it means. And also that there's a consistent relationship between the market value and the book value. That relationship you should know, right? Now let's go. And anyway, this method is not so much asked also. The method which is mostly asked under market based is earnings yield, price earnings ratio. Price earnings ratio is the method asked under market based model the most, right? And in the asset based, the first model, the both two method are asked. It could be leverage CIV, or it could be the book value plus. And the third, right, this method, this model, you need to be very careful because all the three methods requires a lot of work. All the three methods could be asked. All the three method. I cannot pinpoint and say this is 100%, this will come 50%. No, all the three methods have equal chance of appearing in the exam. So this method you need to work more on. Because market based we know price earnings ratio, cash based we know, asset based we know it's market book to market value, book value plus. But cash based model is one model where you need to study all dividend, APV, FCFE or FCF. So I cannot tell you, but I have solutions for all the three models. I have summarized it and written down what you need to focus on. Right? Next, first thing about dividend valuation model, should use cost of equity, not cost of capital. This you need to take care of. Don't get confused with cost of equity and cost of capital. There are two different things. Cost of equity should be used when dividend valuation model is used. Whenever dividend word comes, think of equity. Dividend is for whom? Equity holders, shareholders, ordinary shareholders. So equity comes. Automatically, you know it's cost of equity. This is how you link. This is called smart study. You are not studying all the hard way, trying to memorize cost of equity for this, cost of, no. Dividend means equity, so cost of equity. Sounds easy, right? Apply it, your life will become very easy. Next, no growth in dividends. See, Now first we are testing what happens when there's no growth in dividends, then we'll see what happens when there's a growth, right? Under this dividend valuation model, anything can happen. First scenario we are taking without growth, right? We are assuming there's no growth in dividends. What happens when there's no growth? Constant growth in dividends. So there are three. First is no growth in dividends. Second, there could be a constant growth in dividends. Third, there could be a constant growth in dividends for n number of years. Let's say for 2 years, growth was 2%. But after the second year, from third year onwards, the growth is 5% in perpetuity thereafter. You must have heard this line, right? So you should be comfortable in under all the three methods: no growth, constant growth in few years, and then n percentage in perpetuity thereafter. So all three methods you need to cover, right? And there's a question example, right, from your textbook, page 319. Page 319, there's a question. All the three methods are discussed under one question itself: no growth in dividends, constant growth in dividends, constant growth in dividends, the third one, right? So you can check that, and that one question itself will be enough for you to understand the whole thing, right? You don't have to focus on so many questions. Then let's go to the second model, which is your, and dividend valuation model, you know the method, formula is on your formula sheet. And next, this one, this I have given in a table because I wanted to show you the difference between the two, right? FCF and FCFE, free cash flow and free cash flow equity. This is the second method of the cash based model. This method is also asked very regularly. So free cash flow, first we'll see free cash flow, right? I'm sure by now you must be confident in this topic. I have explained in section A and B, section B, right? Even in your investment appraisal, this topic was there. Even in your acquisition budget, this topic is there. But the theory is same. The concept is same only. It does not change from here to here. Only the way you come up with an answer might be different. But the theory, how do you find FCF is same only. You should know how to find FCF. You should know how to find FCFE. So first bullet point under FCF is identify free cash flows of target company before interest. Mark this word, before interest. Free cash flow before interest. Why before interest? Whenever it's free cash flow, it is before interest. Right? And when it's free, now go to the second one, FCFE, the first bullet point. Identify FCFE of target company after interest. So you can see if it's FCF, if there is no E in the end, it's before interest. If there is an E at the end, after interest. You have to learn it like this. Second bullet point, discount FCF at WACC to obtain NPV. FCFE, discount FCFE at cost of equity to obtain NPV. Main difference, and this is the main area where students go wrong. They take the wrong percentage to discount. Taking WACC for this, taking cost for equity for the other one. It's not like that. If it's FCF WACC, if it's FCFE, E is there at the end. E stands for equity. So cost of equity. Clear? Learn it like this. Just learn one method. One, you will know for the other one. If for one it's cost of equity, for the other one it's WACC. So if it's FCFE, E is equity, cost of equity. It's easy, cost of equity. That means the other one, FCF, is WACC. That's how you learn how to discount. Third one, when you have to find the value of the target, right? FCF, free cash flow, right? Now, this free cash flow is for all. It's not just for the equity holders. It's not just for one, it's for all the stakeholders, right? For your debt holders, for your equity holders. That's why net present value minus debt, you have to minus your debt. Because you only want value for your equity holders, value of the target. Value of the target goes to whom? Only for the equity holders. Does not go for the debt holders. That's why you have to minus debt. Net present value minus debt. And when it's for FCFE, no minusing in debt. Your net present value itself is the value of target. Understood? Only in FCF, net present value minus debt. But FCFE, free cash flow to equity, is already FCFE. You don't have to minus debt over there. So your net present value itself is the value of the target. Right? So please make sure that you go through this. When you study these two things, study these two things together at once like this. Start comparing and learn. Don't study separately, you will get confused. It will save time. It's very easy like this to study. Keep the two table in front of you, or you can take a screenshot of this and learn it like this. Next we have APV, the third method under cash based model. The last method also, the valuation model. Right? Okay. What you have to learn for cash based model, this could be adjusted for, right? Cash, I'm talking about cash only. This could be adjusted for financial risk. This could be adjusted for business risk. There are two types of risk we all know. First, we are going, if it's for financial risk. Financial risk means finance means APV, adjusted present value, because it takes into account the effect of finance. That's why financial risk. APV we all know how to calculate, but under this circumstance, under accusation, now we'll see what are the steps to calculate. First thing you have to remember is an accusation is valued by discounting free cash flows to firm. See, free cash flows to firm. It's not free cash flow. Free cash flows to firm by ungeared cost of equity and then adding present value of the tax shield. So we know about the present value of the tax shield. I'm not working focused about it. I am worried about the other one, ungeared cost of equity. I have underlined it in red. I've written in red for you to see properly which one you have to use to discount ungeared cost of equity, not geared. Ungeared cost of equity, because it's free cash flow to firm. So don't go and discount by WACC. Whenever APV comes, whenever you have to discount FCF to firm, always ungeared cost of equity. And it should be ungeared. There's a formula also to find geared cost of equity and ungeared cost of equity. That method is given to in your formula sheet, so please go through that. Right? You should be knowing how to get ungeared to geared and geared to ungeared cost of equity by using that formula. Right? That's given in your formula sheet. Go through that. Next, why we are taking this method? If you see with our adjusted present value, which we have studied before, very similar. What did adjusted present value told you? Find the base case net present value as if totally equity financed. That's why even this is equity finance. No debt, no finance, only equity finance. That's why we are dividing by ungeared cost of equity. Otherwise, we would have taken back, but no. Whenever adjusted present value comes, whether under net present, whether under your investment appraisal, right, in your net present value, or in your accusation, you always have to use cost of equity, because we are assuming it has all equity financed, and then we are adding the present value of tax shield. Right? Next, I have even written the formula also for you. Right? So you don't have to do all the hard work. I have done all the hard work for you. For you all, I've written down the formula. What you have to do is you just have to understand how the formula works with your initial understanding of adjusted present value. Okay? Adjusted present value equals to value of acquired company if all equity financed. So your understanding of adjusted present value with your initial understanding remains same. There is no change in that. Still equity financed only. But that time it was net present value if all equity finance. This time it is value of acquired company. That is the only difference. Plus present value of tax shield. Again the same thing. Minus. What do you have to minus? Initial investment you have to be minused. What is the initial investment? That is the acquisition cost. And minus your debt. You have to minus your debt because your adjusted price, the value goes to equity holders only. So debt has to be minused. So the answer what remains is your adjusted present value. Whenever you are given to find adjusted present value, you should know how to calculate adjusted present value. Make sure you know now. Write down this formula, take a screenshot, right? Learn it any way you want to, and also share this with your friends on your social media group. And if adjusted present value is positive, then acquisition should be undertaken. So this is your decision, right? Whenever you are using this method and you have to recommend whether acquisition should be taken or not, see whether it is positive or not. If adjusted present value is positive, yes, acquisition should go ahead. Next, adjusted for business risk, right? So financial risk talks about adjusted present value. When it comes to business risk, what does business risk tells you? What is changing in this business risk? Step 1. Business risk means it's about beta, asset beta, equity beta, finding WACC and all those things. So business risk deals with your betas. You know that much, rest all you will be able to calculate. Financial risk deals with adjusted present value, business risk deals with beta. If you know this much, you will know how to work out the rest. Same method, the way we find equity beta, asset beta, then WACC. So the same we are finding here. But this time it is for a group company, for a combined company after acquisition. That is the only difference. Rest all everything remains the same. All the steps. First you have to do, what do you have to do? There are 6 steps. First step is you have to calculate the asset beta of both the companies. Right? Sometimes you might have to calculate, sometimes they might have already given you the asset beta. If they have already, I have also seen this mistake in candidates, that sometimes what happens is they are already given the asset beta, but because they have memorized, okay, step 1, step 2, step 3, step 4, we have to calculate asset beta, they again go and started calculating asset beta, wasting time. Please don't do this silly mistakes, don't do this stupid mistakes, don't repeat it. Right? If it's given already, don't go and calculate it again. Don't just memorize step 1, step 2, step 3 blindly. Right? Understand and then memorize. Then know how to calculate. If asset beta is given, don't go and calculate it again. So it might be given to you sometimes. Sometimes what happens is only one asset is given to you. One asset beta, one company is given. The other one is not given. But there are other information from which you can find that asset beta of that company. Right? It's like fill in the blanks. Next, calculate average asset beta for group post acquisition, right? Now it's one company. So for that you have to find one asset beta only. Group company, right? Post group post acquisition, right? It means one company, combined company after acquisition. The two comes together. So for that company you have to find only one asset beta, average asset beta, right? Calculate the average asset beta. Step 3. Find the equity beta of the combined company. Once you get the asset beta, next you have to find the equity beta. We all know after asset beta, trinity equity beta, we know how to find equity beta using formula. Next, after you get the equity beta, you will get the cost of equity in your CAPM model, right? Cost of debt also will be given to you. Using both, you can find the group's new WACC. Group's new WACC means not that this group is having one WACC, that group is having, no, it's only one WACC. Now it's one company. It's combined together, one company only. That new company is having new WACC, right? Then what happens? We need to find that new WACC for that group. Why? We have to discount. We have to discount it. We need a discounting factor. If we don't discount, how will we find the present value? And we have to find the present value. This is cash based model. Cash. Whenever cash comes, we have to find the present value. So whenever present value comes means we need a discounting factor. Thing like that. Whenever cash is there, we need a discounting factor because we have to find the present value. But if it's market or asset based, then it's okay. We don't have to. So always WACC and all, we always have to work under cash based model for this WACC and this method, right? Finally, not finally, one before the last. Step 5 is discount groups post acquisition free cash flows by new WACC. See, free cash flow. Now just see the terms. Always just see when it changes from free cash flow to firm and free cash flows. Free cash flows you will discount by using WACC. Free cash flow to firm you will discount by using cost of equity. So this is free cash flow by new WACC, right? You cannot use the old WACC, by the way. You cannot use the WACC of that company before acquisition. Let's say the parent company, the one who is going to acquire, right? His WACC is 10% currently with before acquisition. You cannot go and use that 10% even after acquisition. You cannot use that 10% for discounting. You need that WACC will change after acquisition takes place. This you need to understand. That's why we are finding all this groups new WACC. Step 6, calculate groups. Okay, and also remember one thing, all these steps you don't have to do if the business risk does not change after acquisition. You only need to do, just see in your scenario somewhere they might give that business risk has been changed, business risk is affected by acquisition. Then only if it is changed, if business risk is changed after acquisition, then only you have to do all the 6 steps. Otherwise it's not needed. You don't have to do these 6 steps. You can use the same WACC as before acquisition if business risk is not changed, right? So step 6, calculate groups revised net present value and minus debt to calculate value of equity. Of course you always have to minus debt to find the value of equity from the net present value. So that's how you will get the value. Next, I have told you all these methods are for established businesses and all this. Now what happens if it's a high growth startup companies, right? Valuation of high growth startup companies. This time what should we do? For this, what are the characteristics of high growth startups? You need to know this. Before you suggest that this are the values, you need to know why. To know that why, you have to know what are the characteristics. What are the characteristics? You can type and tell me. You can comment down and tell me what are the valuation of high growth startups. It's very easy. You will be seeing that they are initial years they are going on losses and not making any profit. They don't have any track record. They are inexperienced management. The revenues are not much, very few revenues, and also most of the products are untested products. Market, they are not accepted by in the market, right? Unaccepted market acceptance. Their product demand is unknown because they have just started, right? Competition is unknown. They don't know what their competition are. Even their cost structures are unknown. Mostly they are in that where their infrastructure and development cost are most high in this space, right? Their development cost, infrastructure cost. So what happens? Because of this few reasons, because of their characteristics. Why I mentioned started with first characteristics of high growth startups, because of this characteristics only. Some valuation models you cannot use and some you can use. Let's go. Before we go to the valuation methods, first you have to know this in more detail about high growth startups. For most high growth startups, retention rate is equal to 1. What is retention rate? What is retention rate? See, retention rate is one whatever profits you get from that business, right? Initially, since you are loss making, you need money, right? You badly need the money to survive for the long term, at least for 7 years, let's say. You need money, so you cannot take that as your profit and invest and use it freely as your will. You have to retain it in the business so that your business grows. So fully it will be retained. It will be retained fully. It will be retained and reinvested in the business so that it keeps on growing. That whatever the profit you make in the first year will be reinvested for the second year, again third year, fourth year, keeps on going, and it will be retained fully 100%. That's why the retention rate, I'm not saying for all, but for most it is 1. You might be given a different rate also in the exam, so based on that. But why I am giving you the retention rate is because you have to, if they might tell you to focus the growth, right? when you have to focus the growth, what is the growth model? There are two methods of evaluating growth, right? One we have studied yesterday, right? Newest dividend divided by oldest dividend. But how will we know about dividends here, newest and oldest? We don't have that track record here, right? One of the characteristics of high growth is they don't have a track record. So you cannot use that method. The other method you can use is the Gordon's approximation method. The formula is given in your formula sheet, right? The formula is, right, the growth equals to retention rate into your cost of equity. So your cost of equity, so your retention rate is 1 multiplied by your cost of equity. So the only thing that can affect your growth is what? Only your cost of equity. Only your cost of equity. That's it, because retention rate is 1. Right? So 1 multiplied by cost of equity, whatever cost of equity, that will be your growth. Right? So that's why I've told you the characteristics are very important. Next. Now, you need to know for value high growth startup company. That's why always mark in your highlight in your case study which type of industry, which type of business your business is in which stage, in which product life cycle. Is it in the growth? Is it in developed? Is it matured? Is it declining? All this matters a lot for your valuation purposes. If it's a high growth startup, you cannot use asset based and market based. There's a problem if you use it. What are the problems? Asset based you cannot use. Why? Because initially you will not be having so huge amount of tangible assets. You will not, forget about intangible assets, right? Intangible assets you will not have, so you cannot anyway use the CIV method. The third method, the leverage method, also you cannot use it. First method, book value plus, for that even your tangible assets will not be so much, right? It will be, but it will not be so much. The value will be very less, so it is not appropriate to start up that business, because most of the investment of a startup is in the people, marketing. They will be promoting, marketing, right? They, so all these are treated as expenses. They are not capital, they are not tangible assets. All these are what? Expenses. You are investing where? On promoting, on marketing, on human, setting up staff, training them. All these are expenses, they are not capital. So you cannot use asset based here. It's not appropriate to use asset based, right? Second method, let's go to the market based method. It's a high growth startup. Can it have a price earnings ratio? Then earnings yield, right? Or the third method, which we studied under market based, the market to book ratio. Can they do any of this? They don't have a track record. I told you one of the characteristics of high growth is they don't have a track record, right? Also, it's hard to compare this company with anyone. It's hard to find a company who are in the similar stage of this high growth startup so that you can take the price earnings ratio. It's difficult to compare, right? There might be lack of disclosed information. There might not be earnings, right? All will be like losses, right? So it's hard to find price to earnings ratio. Next, third, cash based model. Yes, this model can be used. Cash based model, right? So most suitable method for high growth startup is discounted cash flow. This is more suitable. Why is it more suitable? Is because cash, right? We can use the free cash flow or free cash flow to equity. Cash will be having, right? So the formula when it comes to high growth startup, this is the formula. I've written down it for you because this formula is not given anywhere in your formula sheet. So I've written down here V is the value of a company, right? Equals to R is your revenue, and C is your cost, right? Capital R is your revenue and capital C is your cost, right? Why? Because your revenue minus cost right? Your when it's high growth startups, like your revenue and your cost, it's different. They grow in a different rate. That's why I have put it as R minus C, right? Your revenue and your cost is different. If they would have grown in the same rate, we could have just taken R minus C divided by R minus G. But this is different. Revenue is growing at a different rate, cost is growing at a different rate, right? So that's why R divided by, you have to discount it. It's a discounted cash flow. The denominator is a discounting factor. What is the small letter r? The small letter r is what? That is the growth rate. That is the cost of capital. Cost of capital. That r is cost of capital minus gr or gc. So gc is the growth of r, growth in the revenue, and gc is the growth in the cost, the growth rate in the cost, right? So cost of capital minus the growth rate in revenue or growth rate in cost. So this is the formula which I have to use. This is not given in the question. I have never seen a past paper with this question, but if this is given, then you should be able to explain these points, because there's not so much to explain under this point. So these are only the points which I have covered here. These are the only points you need to talk about. Next, expected values. The second method you can find is, second method other than discounted cash flow, you can value is using expected values. Expected values you can use. You will be given some probabilities, right? And the values, multiply the probability and the value, you will get the expected value, right? Next, so that's it about startup companies. The next things, these are some of the key aspects of what about takeover regulation. There's a regulation in takeover. Why? Because takeover, like, you cannot just take over any company you wish to. You should be given the permission, which is regulated, so that no company creates a monopoly, right? No company acquires a company, becomes so big and they started dominating the market, right? The takeover should be beneficial for the overall economy. Then only it will be allowed to be taken over by the regulations. So there are some regulations. First thing, these are the few things which you need to know about the regulation, the aspects of regulation, right? Mandatory bid rule. What is mandatory bid rule? There are in fact 7 key aspects of takeover regulation. You need to know all the 7. Not so, even if not so much in detail, but at least briefly you should explain 1 or 2 points. You should be able to explain under each if asked for. What is mandatory bid rule? In the mandatory bid rule, right, this is to protect the minority shareholders. The aim, mainly this aim is to protect the minority shareholders by providing them with the opportunity to exit the company at a fair price, right? So they can exit the market at the fair price. Once the bidder has accumulated a certain percentage of shares, let's say currently me, I am the acquirer, and you people are the target company, right? I'm having 50% shares already. So now I'm taking 30% from you. So how much I have? How much am I left with? 80%, right? After I take over, I become 80% owner. 50 and 30 of yours, so 80. So now you are only left with 20%. You are the minority shareholder, right? So now you have an opportunity, you, the target company, you have an opportunity to sell your 20% to me. Sell your remaining 20% share to me so that I become a 100% owner and you can exit out of that company. But when I sell you, like when I buy from you or you sell to me, that should be at a fair price. It cannot be too low, right? I cannot purchase at too low from you. It has to be at a fair price. So there's an opportunity for you to do that. Why this rule is there? Because this rule is there to protect you people, to protect the minority shareholders. Because me, once I become 80% shareholder, I might exploit my position. I might dominate over you. I will not take care of you. Because I'm just a minor shareholder, I might mistreat you. I might not treat you equally. So that's why, to protect you, you means who? The minority shareholders. So they have a chance that they can sell out their remaining shares to the majority shareholders. So they are protected. They will get a fair price. So that is known as mandatory bid rule. Second, principle of equal treatment. Right? In this, they are saying that all shareholders should be treated equally. Right? It is self-explanatory by the word itself, equal treatment. Right? In other words, they are saying that the bidder, right? It requires the bidder to offer to minority shareholders the same terms as offered to the earlier shareholders from whom the controlling block was acquired. Right? Let's say before, like now I'm having 50% shares before I acquire. So I'm acquiring 30% now. So the time I'm acquiring 30% from you, the treatment which I'm giving you to acquire that 30%, the same treatment I should give after I acquire that 30%, right? I'll be getting 80%. So that to the remaining 20% shareholders who are remaining after acquisition, I should give them the same treatment. That's what equal treatment means. Third, transparency of ownership and control. Right? This video might get long. It might get up to 2 hours, but it's important. Like I'm covering all the important points. I'm sorry I cannot make it more short. I'm covering all the important points and it needs to be covered. And I'm spending more time on each so that this concept becomes easier. Right? Otherwise, I could just give you the points and say, okay, go and study from a textbook. But I know this is the last moment, and I don't want to pressurize you. Already, I know people are so much pressurized. So that's why I'm explaining in easy terms so that you might be able to just go through briefly and write it so that you don't have to go through that textbook again and read and memorize it. There's no time for that. So even if it takes more time, please bear with me. Okay. And do make sure that you watch this video till the end because we also have reorganization and reconstruction to cover. Uh, Transparency of ownership and control. This is very easy, right? Everything has to be transparent. The disclosure of information, who is the major shareholder, who is the minor shareholder, needs to be very transparent, right? This is to protect the investor, right? Why this transparency is there? Because this transparency, it enables the regulator can monitor whether the large shareholder, are they discriminating the minority shareholders, are they exploiting their position as majority shareholders, are the minority shareholders protected? The regulator wants to monitor all this. That's why there should be a transparency of ownership and control. Who is owning, who is controlling? All this has to be made very clear, right? Also, another reason is this minimize the agency problem. Agency problem could be minimized because of the transparency of ownership and control, right? Next, fourth, squeeze out and sell out rights. So what is squeeze out? And by the way, there is no numerics question, right? There is no numbers on this. All are theories, right? On takeover regulation and all. So squeeze out and sell out rights. What does it means? Right? Squeeze out means, okay, it's two different things. One is squeeze out, one is sell out, right? So squeeze out means this gives the bidder, the one me, let's say I'm acquiring you. So it gives me the right to acquire the specific percentage of equity, right? Usually 90%, let's say. The right to force minority shareholders to sell their shares, right? Like me as an acquirer, I have the right to force you to, let's say I have 10%, right? 90% I have acquired. The remaining 10% I can force you, right? I can force you people to sell that 10% to me. I can force you. I have that right. That is known as squeeze out. I can squeeze out from you people. That's why that word squeeze out is there. Sell out is the opposite. It is from your point of view, right? It means it enables the minority shareholder, that's you, right, to require the majority shareholders to purchase their shares. That means you have the right? It's enabling you to convince me to purchase your shares. You are telling me to buy your shares. You are willingly telling me to buy your shares. right? It's enabling you that this sellout rights. So it's both the way, right? It's working both the way. One is squeeze out, one is sell out. That's why squeeze out and sell out rights. This threshold could be anything. It could be at 90%, it could be 95, it could be 100%, right? In different countries is different rates, but we are not interested. We don't have to know about those rates. About rates and all, you don't have to worry about. You just have to know what it means, right? Fifth, the share, one vote principle, right? What does it mean? With this principle, if this principle is upheld, that means arrangements which are restricting voting rights are forbidden. They are not permitted. They are restricted. You cannot restrict any voting rights. If you have a voting right, you should practice it. You cannot restrict the voting rights under this. If you try to restrict the voting rights, it is not allowed, right? Next, breakthrough rule, right? What does the breakthrough rule means? Breakthrough. You're breaking through something. You're breaking through the law, right? So, breakthrough rules means, okay, according to this rule, the bidder, the one who's going to acquire, right? The acquirer, with a specified proportion of the company's equity, to break through the company's multiple voting rights and exercise control as if one share, one vote existed. Right? They can break through the multiple voting rights and exercise control as if one share, one vote existed. That is known as breakthrough rule. Right? Next, multiple voting rights means you are having one share, but you are voting multiple, you are doing multiple votings. What happens is, because of that multiple votings, you are acquiring more, you are acquiring control, you are accumulating control at the expense of other shareholders. Other shareholders who are having only one share, one vote, they might not be able to get the control. So it's unfair for those shareholders. You having one vote but multiple rights, multiple voting rights, right? You're having one share but multiple voting rights is not fair for the other shareholders. So because of this, this could be a significant barrier for the takeovers. That's why this one share, one vote rule has been given, right? And the next is breakthrough. You can break through that multiple voting rights. Even if you have multiple voting rights, you can break through and you can just exercise as if only one share and one vote existed. Next, the last one, board neutrality and any and anti-takeover measures. What does it mean? Anti-takeover measures. Then what happens is, here you might see that management, right? They might be tempted to act in their own interest. They might want to acquire a company for their own self-interest, not because it will increase the shareholders' wealth, right? So because of these reasons, there are many regulatory devices, right, which propose board neutrality, right? So what it says that the board is not permitted, right? They are not permitted to carry out any tactics, defensive tactics. Like, there are so many defensive techniques, right, to defend themselves from not being taken over. They want to defend. They don't want to be taken over. So they want to defend. They want to stop that takeover from going ahead. So for that, management takes many actions. They take many tactics. There are so many tactics which we'll learn later, right? After this, maybe. Next slide we have. So that is not permitted, right? Board, because of this rule, last rule, board neutrality and anti-takeover measures, is known as anti-takeover measures, is not allowed, right? Without the prior authority of the shareholders. If you have to practice such tactics, right? If management of the board wants to practice any defensive tactics, they need to take permission of the board, shareholders. Sorry, they need to take authority. They need to take permission from the shareholders before, otherwise they are not allowed. So these are some of the aspects of takeover regulation. Make sure that you know each one of them. Next we have, yes, defensive tactics in hostile takeover. Most of the time you might be seeing that takeovers are not friendly takeovers, they're hostile takeovers against the wishes of maybe the management of the target company. They don't want, against their wishes, right, a takeover has happened. So what happens is they want to stop that takeover from happening. There are so many tactics which they apply, which they do to stop it, right? So what are those tactics you need to know, right? Before the tactics, you need to know that there are two potential conflicts of interest. Because of these two potential conflicts of interest, all these regulatory actions are there for takeover. Because of these two potential conflicts, what are these two potential conflicts of interest, right? Can anyone tell me what are these two potential conflicts of interest? Okay, the first one is, right, there are two main agency problems which regulation are seeking to address. One is protection of minority shareholders, right? Because most of the time takeovers, minority shareholders needs to be protected, right? They're in a risk, they're in a danger. That is the first conflict of interest, first reason. The second one is, right, management of the target company. They may implement measures to prevent the takeover which are against the stakeholders interest. So there is a agency issue between the stakeholders interest and the management's interest. And in the first one, there's a conflict of interest between the minority shareholders and the majority shareholders. So because of these two conflicts of interest, two agency problems, we there are so many. There were all this rules, right? The breakthrough rule, one share, one vote principle, and all. Now we are going to cover the defensive tactics, right? So these are the defensive techniques. The golden parachute. This is the first defensive tactics, right? What is golden parachute? Golden parachute is like gold, right? Golden parachute means large compensation payments are made to the top management of the target company, right? If they find that their positions are eliminated due to the hostile takeover, if the management fear that their position is going to be uh, taken over or they're in a risk, what happens? They demand for a huge compensation. The management of the target company, they demand for a huge compensation from the acquirer company. It could be cash, it could be a bonus payment, it could be stock options, or it could be a combination of any of this. What happens is this makes it less likely to a takeover to happen. Why? Because acquirer company has to pay a huge amount to the management of the target company, right? They might not want to do this, right? If they have, it's fine, but if they don't have enough finance, that they might not want to simply give so much of compensation to the management, right? This is just a tactic for them to, for the takeover to not happen, not to take place, to stop the takeover, because they know that if they demand for a high payment, they will stop, the acquirer will stop, and the takeover will not happen place. So it's known as golden parachute, gold, right? Second, poison pill. What is poison pill? Poison pill is, this is they're trying to make the company look unattractive. By how? By giving the right to existing shareholders to buy shares at a very low price. They are selling the shares to existing shareholders. They are telling, okay, they are giving the right to the existing shareholders to buy shares at a very low price. This will make the company unattractive to buy. It's known as poison pill, right? Next, white knight. What is white knight? White knight is like you are inviting, okay, let's say that you are in a problem, right? Okay, or maybe you are in a, let's say a guy likes a girl, okay, but that girl does not want that the girl does not like that guy, and that girl does not want to go out with that guy, but that guy is like in a defensive, like in a aggressive. Okay, he's aggressive. So what happens in that, he anyway wants to take the girl, right? What happens is that girl, he calls his friend to rescue her, right? He tells that guy, he tells another guy who is his friend, please come and please act as my boyfriend, right? So that this guy leaves me and does not trouble me, right? So that friend comes and acts as a boyfriend. So what is his friend doing, her friend doing here? Rescuing her, acting as a white knight, right? So that's known as white knight, rescuing. Okay, you are rescuing her. So in the same way, you apply for acquisition and mergers, right? When you are when you don't want to be taken over by some company, maybe that company you don't like that company, unwanted, right? Unwanted bidder. What happens is you you invite another company to take you over, to take over. It's like a counter bidder, right? A friendly counter bidder. They just add that they are going to take over your company, but actually they are not taking. Right? That is just to stop the unwanted bidder from taking you over. They're just acting to rescue, right? So that is known as wine. And now fourth one, crown jewels. What is crown jewels? Jewelry, right? Most valuable assets, right? What is the main reason why someone wants to take you over? Maybe because they might have some valuable assets in that company. So what happens? They are now, that is the main reason, right? So they're selling this main jewelries. They're selling that main asset, right? The valuable asset of the company before the takeover takes place, right? So they're selling, right? Or if they don't sell, they might enter into an arrangement such as sell and lease back, right? What happens? The firm is, what the target company is doing by doing all this, they are making themselves less attractive as a target. So now the acquirer might not want to acquire them anymore, because that reason of acquiring them was their valuable asset. If that valuable asset is not there, was the reason of them acquiring that, right? So they might back off. Crown jewels, right? Jewelries. So they're selling off that asset, or they might sell and lease back, so that they don't become attractive to the acquirer anymore. Now the sixth one is, the fifth one is Pac-Man defense or basement defense. What is it? You must have heard that game, right? That basement defense we used to play early, where that guy used to eat all, right? So this is like an attacking. It's an aggressive form of defending, right? This is like rather an aggressive rather than defensive technique. You can defensive technique, you could say, right? But this will not work in any situation. This defense will only work where the original acquirer is a public company with diverse shareholdings, right? So this tactic also appears to suggest that the company's managements are in favor of the accusation, right? See, they're saying that the managements are in favor of the accusation. They want the takeover to go ahead, but they disagree about which company should be in control. So there they will disagree. They might be okay with taking over, but they might not be okay if they want to control, if the acquirer company wants to control the company. There they can disagree. Next, the last one is litigation or regulatory defense, right? So here the target company, they can challenge the accusation by taking them or inviting them to the court. They can invite an investigation, right? They can tell the regulatory authorities to carry an investigation on this accusation, or they could go to the courts, right? So what happens is the target company, they might be able to sue for a temporary order. They're taking a temporary order from a court, and they will be able to sue the acquirer to stop the bidder, to stop the takeover from going ahead for a short term, for a temporary. It's possible. So these are some of the defensive tactics. Now let's go to how mergers and acquisitions are financed. It's very important that how it is financed. Right, so these are a few methods of financing acquisition and mergers. First one, cash purchase. Right, you could buy with cash, pay cash and buy it, very easy. Not much work is required here. Let's go to the second method, okay, now cash is okay, but where does this cash come from? That you need to know. Cash could come from the retained earnings, cash could come from a debt issue, right? Maybe from money could be raised by issuing bonds, right? Loan from bank, you could take a loan from bank. Or fifth one is mezzanine finance. What is it? This is a new term, right? This is this form of finance will study in more detail later. So for right now, let's keep it, right? We are going to go through this in more detail later in this video. Second way of financing is share for share exchange, right? You are paying your shares to take over their shares, right? It's like share for share. Make sure you know the calculation part of the share for share exchange, right? Because this is also an area where many candidates struggle to find their share for share exchange. Convertible loan stock, that is the third, convertible loan stock, where your debt could be converted to shares or shares could be converted to debt anyway, right? Convertible loan stock means your debt will be converted to shares in the future, right? Mezzanine finance and takeover bids. So mezzanine finance is another way how it could be taken over. Now let's see what is mezzanine finance. Mezzanine finance is somewhere between debt and equity. It's not fully debt, it's not fully equity finance. It's somewhere between, right? It lies between equity and debt financing, right? And the detail of this mezzanine finance, you can check on my videos under financing mergers and acquisitions, right? My before videos, where I've given what is mezzanine finance. So you can go through this, how it works and how it is arranged. You can go there and check. Next, earnout arrangements. What is earnout arrangements? See, the earnout arrangements means the purchase consideration, right, might not be paid all at the time of acquisition. It might be paid in installments. It could be deferred, right? Or it might be payable on certain by on achieving certain performance target. Let's say you are achieving 5% profit, then I will pay you. Something like that. Some, right? So it might be contingent on the performance target. So that is known as earn out arrangements. You are not paying all at the same time as the acquisition. You might be deferring for later, right? So these are some ways of methods for financing mergers. Mostly the first three methods I have seen: cash purchase, share for share exchange, and convertible loan stock. These are the three most common methods of financing mergers. So make sure that you know these three, right? Now, choice between cash and paper offer. How are you going to choose between a cash and a paper offer? For this, we need to look from two perspectives: shareholders in the bidding company's perspective and shareholders in the target company's perspective. Cash and paper offer. Paper offer is share for share exchange. That is known as paper offer because everything is on paper, nothing is on cash. Cash is not changing place. So if you're taking from the point of view of the bidding company, these are the important reasons why they will choose cash or paper offer. First one is dilution of EPS, dilution of earnings per share. That means if they go for share by share exchange, right, their earnings, their share will reduce, percentage of share, right, their control in the company will reduce because they're giving up some of their shares to the target company. So they might want to go for cash. They might not choose paper offer, might not seem attractive to this, right? Because the EPS will dilute because of that. Second, cost to the company, right? So if they use the loan stock to back cash offer, right? Like they are taking loan for the cash to get cash, what happens? It will attract tax relief. There will be a tax relief because you are taking a loan. Whenever you are taking a debt attracts tax relief on interest and having a lower cost than equity. So that means it will have a lower cost than equity. That means in this way, cash might be a attractive, better choice than share for share exchange. Because when you're having cash, you are taking a loan to get a cash, you are getting an interest on tax relief. But when you're taking shares, there is no such relief. So in this case, again, they are saying cash might be better. Third, gearing. So in this, they are saying that if the company is already highly geared, they might not be able to take any more loans to get cash. So in this, they are choosing paper offer might be better, like share in this condition. Next, control. If you are going for share offer, control is going to be lost. But with cash, nothing as such. And then authorized share capital increase. Yes, when you go for general meeting resolution, borrowing limits may have to change, right? When you go for the general meeting, you can increase the borrowing limits. So borrowing limits can increase. So in this way, if borrowing limits you can increase, it's better to go for cash, right? If you set up some general meeting resolution and you can change the borrowing limits over there, right? It might be better to go for cash offer because now you can borrow more, right? Now let's go from the point of the target company. Okay, borrowing limit increase, yes. Target company, they will see tax because they are the one who are going to receive cash or share. So they need to worry about tax. They need to pay that. They are the one who have to pay tax. So if it's cash, if they're receiving cash, right? If it's a cash offer, they have to pay tax. So it's not a very suitable for them because they have immediate liability to tax. But if it's share for share, right? Then they may not have to pay immediate tax. Next, income. Right? If it's not cash, if it's shares, what happens? What happens? Arrangement must mean existing income is maintained. You have to maintain your existing income. Or there must be some growth, reasonable growth expectation must be there. If it's for share, right? Either you are expecting some reasonable growth rate or the existing income has to be maintained if it's share for share exchange. Next, future investment, right? Shareholders who want to retain a stake in the target business, right? They may prefer shares. If they want to have a stake in the target company, if you want to have a stake, let's say I'm the acquirer, I want to have a stake in your company, like you are the target company. So it's a future investment. I will prefer shares, not cash, because with cash I cannot have a stake. I cannot have a holding in your company. I can only buy your company. Next, the last one, share price. If share price is about to fall, it's not an attractive offer to go for paper offer. It's better to go for cash offer, right? Assessing a given offer. You have to assess a given offer. How you are going to assess a given offer? These are the ways. Market values of company shares during a takeover bid. Right? What happens during a takeover bid? What happens to the market value of the company's shares? You need to see. Right? Because let's say if the market price of the target company shares rises above the offer price, right? Let's say your share price is rising more than the offer price, more than the price which I have offered, like we have negotiated, right? What happens? Now the bid price, that offer price will be very low compared to their market value share. So the takeover will not happen. It will likely to be failed. Why? Because the shareholders in the target company now they will not accept. They will not sell their shares to me. Like, right? They will not sell their shares to the bidder for the low amount because their share price has increased. during that takeover bid, during, not before or after, during takeover bid. So that's why knowing what's happening to the market value of the shares is very important during takeover bid, because it can either benefit you or you can lose from it, right? In this condition, if market price increases, it's going to be a loss for you because takeover is not going to happen. Target company will not sell the shares for low amount, right? Now, we also need to know what's happening before and after takeover, what's happening to the EPS, earnings per share, right? Mainly EPS. I'm not talking about any other ratios, but EPS you need to know what's happening before and after takeover. I have written a summary also what's happening before and after, right? Now, this is very important. You need to see whether the target company which you are purchasing, we are buying, are you buying at a lower P ratio or a higher P ratio? Very important. With this, you can tell whether the acquired company is getting benefited or having a loss. So if the target company's shares are bought at a higher PE ratio, then higher PE ratio compared to what? Then the bidding company shares. Very important. You have to see your company shares and the target company shares. Let's say your PE ratio is 5. Let's say I am the bidder. My PE ratio is 5. But the company which I'm going to take over, the target company's PE ratio is 8. It's more than mine, and I'm taking over that company. Right? What's happening to me? The bidding company shareholders will suffer a fall in EPS and vice versa for opposite. Will suffer a fall in EPS. My earnings per share will go down if I still buy that price earning ratio. So in short, it's always good to buy a company at a lower P ratio than mine. In summary, that is what I'm going to say. If I have to buy a company, right, buy a target company, I have to see that the target company's PE ratio is less than mine, so that I can get the benefit. I can get a benefit of rise in EPS. But if it's opposite, then it's a fall. So vice versa for opposites. For opposite means what happens when you buy at a lower PE ratio, that you can figure it out. Now, buying companies on higher PE ratio but with profit growth. Now you're buying on a high PE ratio, but there's also a profit growth. So in this case, you cannot say that shareholders will suffer a fall in EPS because it is compensated with a profit growth. Even if EPS will reduce because of higher PE ratio, but because of that profit growth, it will be compensated, that fall. Right? Net asset per share and quality of earnings. These are the things we need to consider. What is the net asset per share and what is the quality of the earnings? Right? There are three circumstances where your fall in EPS, right, will not affect you. You can accept that fall in price EPS, right, where a fall in EPS will be accepted by you. There are three reasons for that. If three of this benefit results, first benefit is earnings growth. If there's an earnings growth, then even if there's a fall in EPS, still it is accepted. Second is quality of earnings is superior. Your quality of earnings is superior than a fall in EPS. And the third one is dilution of earnings is compensated by an increasing net asset backing. Yes, if your net asset is increasing, because of that net asset increasing, even if your earnings is decreasing, diluting, still it will be compensated. So you don't have to worry about that fall in EPS in these three conditions. Next, we have effect on earnings. Also, we need to know what is the effect on earnings. Earnings what? Because of this given offer, that offer, right? That acquisition price, what is the effect on earnings you need to take care of, right? How will you know what is the effect on earnings? It's very easy. You have to know what is the combined earnings, you have to know the combined shares, and then find the combined EPS. Once you get the combined EPS, right, then you can find out the price of the stock, expected price of the stock, right? The combined EPS into the price earnings ratio, you will get the market value, the market price of the stock, and you can see whether the market price is increasing or decreasing. right? If it's increasing, it's good. If it's decreasing, it's not good. So that way you can find the effect on the earnings. Next, effect on the statement of financial position. You are seeing what's happening to the balance sheet, right? How your balance sheet is changing. You might not be told, right? You will not be told to draw up a full balance sheet and do the changes. But yes, maybe extracts of the balance sheet they might give you and tell you to change some figures, right? Let's say a cash offer is funded entirely by debt, right? And the company makes an offer of 120 million, which is raised by issuing corporate bonds. So in this condition, what happens to the balance sheet? You might be asked a question like this. So you should be able to prepare, you should be able to know what's happening to the balance sheet, right? So that's it about mergers and acquisition. Successfully have completed mergers and acquisitions. Now the next one is reconstructions and reorganization, section D. This is a very small section, and this section is, you don't get this section most of the time, right? But if you get, right, in case like I got during my time, I got a question on reconstructions and reorganization, but thank God I prepared on this topic, so I was able to answer this topic. I was not very comfortable in my, even my exam I messed it up, but still I know somewhere here and there I know, so I was able to write something, right? I was able to manage it, and this was question 3 I guess on my paper. So reconstruction and reorganization is like a surprise package. You might get, you might not get, right? It's not a question which is repeated. But yes, section B, investment appraisal, section C, mergers and acquisition, and section E, risk management. These 3 sections always repeated. And also theory parts, which comes from section A. Right? So let's start. Reconstruction and reorganization. There are 2 different things. First, we are going to cover what is reconstruction, and then we'll go what is reorganization. Reconstructions. There are reconstruction schemes, right? Reconstruction schemes could be to prevent business failure, right? Reconstructions you are changing, right? It could be anything. You are changing the capital structure, right? You are changing the organization structure, or you are making some addition or disposal to the companies through acquisitions or selling companies. Reconstruction could be any ways. Another reconstruction scheme could be for value creation. Maybe you want to create more value. Maybe the current structure is not performing well. You want to change and create more value. So it could be for any of this two, to prevent business failure, for value creation. There are types of reconstruction. There are 3 types of reconstructions. What are the 3 types of reconstructions? Financial reconstructions, portfolio reconstructions, organizational restructuring. What is financial reconstruction? Let me give you a brief. Financial reconstruction is you are changing the capital structure, right? You are changing the proportion of debt equity. That is financial reconstruction. You are only working with finance, debt equity, that's it. Portfolio reconstruction is you are making some additions to that portfolio or disposal. You are either acquiring or you are either selling companies, right? So that's why your acquisition and mergers is very linked to this reconstruction chapter, right? There you are merging, here you are selling off. Opposite of that. There 2 companies are becoming one, here 1 company is becoming 2. An organizational restructuring means you are changing the organizational structure of the firm. We are only focusing on the financial reconstructions and portfolio reconstruction, right? Organizational restructuring, we are not focusing so much in detail. Financial reconstructions, right? So I have explained what is financial reconstruction. These are some ways you can restructure financially. What are these? First one is known as leverage recapitalization. You might not be asked so much in detail, right? But I will just explain in one line. Leverage recapitalization is where a firm replaces majority of its equity with a package of debt, right? So your equity, you are replacing it with debt. Majority of equity is being replaced with debt, right? So that is known as leverage recapitalization. Second, debt equity swaps. for debt for equity or equity for swap. It could be any way, right? Third, leveraged buyout. This there is a more into this. You need to know the advantages and disadvantages of what is LBOs, right? And what is LBOs? In short, I will tell what is LBO. It is like a publicly quoted company is acquired by a specially established private company, right? So it's like private companies acquiring the public company, right? That means it's a procedure for going private. From public, you are going private. That the final, the fourth financial reconstruction is dividend policy, right? So by changing the dividend policy or by the retention rate, you can change. It's a you can change the capital structure of the firm, right? Then financial reconstructions and firm values. You need to know what is the impact of the financial reconstructions on the firm values. To know this, you have to know two things. One is the effect on the growth rate, right? And to know the effect on the growth rate, you can use the formula of the Gordon's approximation, which is on a formula sheet, right? And then effect on the systematic risk. Whenever systematic risk is there, you need to talk about it's about equity beta and asset beta. Everything else is same, right? The older thing is now you need to change your now you need to know what is the asset beta, what is the equity beta, right? After reconstruction scheme has taken place, right? Before we focused on what was the change in the equity beta, asset beta, what is the new WACC after acquisition and mergers of the combined company. Now we need to know what is the new WACC after reconstruction has taken place, right? For example, when you're changing equity for debt for equity, right? Higher level of debt means beta, the geared beta, the equity beta of the company will increase, right? And if you're having a lower debt, that means it will reduce. So you need to know what is the effect on this asset beta and equity beta, right? So most out of this four financial reconstruction, right? Debt equity swap and dividend policy, these two are the mostly used, right? And make sure that you know the advantages and disadvantages of LBOs, right? Mainly of going private. Next, yes, leverage buyout. So you need to know the advantages and disadvantages of going private. So for example, one advantage could be the listing. The cost of meeting listing requirements will be saved now because now you are going to from public you are going to private. Also, you are less attractive for a hostile takeover bid, right? Companies also protected from volatility in the share prices, and also the shareholders will be closer to the management, so agency problem will be solved. One disadvantage is that the shares cannot be traded in public, and also it will lose some of its value. So this is one of the disadvantages of LBOs. Next, what we need to know is step-by-step process to assess the reconstruction scheme. This is very important. Whenever reconstruction schemes question appears in your exam, you need to know what is the step-by-step approach to this. That's why I have done this for you, because I was in a confusion whether I have to include this or not. But then I thought, no, it is very important. Step 1, you have to estimate the position before reconstruction takes place. Step 2, you have to assess the additional sources of finance, because you need additional sources of finance, right? Third, calculate and assess new position after reconstruction and compare with step 1. 4, check the company is financially viable after reconstruction. How will you know it's financially viable? When the new position under step 3 has improved compared to step 1, then you will know it's financially viable. Otherwise, it's not. Step 5, sorry, that is the fourth step. So whenever you have to recommend something, whether the reconstruction is financially viable for the company or not, you need to know these 4 steps. Then only you can recommend, right? And when you do this, you also need to take care of few things, right? When this step reconstruction is there, right? Lenders must be persuaded that the company has a good chance of being financially viable, right? Lenders has to be persuaded, otherwise there is the reconstruction schemes will not likely to succeed. For it to succeed, lenders must have trust on you. They must be persuaded that there's a chance of company being financially viable. Second, it must involve a creation of new share capital, cancellation of existing share capital, right? Or also it could involve the conversion of equity debt or equity to debt, right? Or one type of debt to another. And third thing, for reconstructions to be acceptable, it needs to treat all parties fairly. Who are those all parties? Your equity holders, shareholders, your preferred shareholders, your creditors, they need to be treated fairly equal, right? And reconstruction finally it should mean that arrangement should be in place to pay off all the company's existing debts in full. All the debts has to be paid in full, right? All your creditors has to be satisfied. They need to be paid in full. Then only you can say that a reconstruction scheme is successful or viable, right? And also you need to show what is the impact of the financial reconstruction on the financial statements, right? And how it will impact on different stakeholders. For example, the ordinary shareholder, preference shareholders, or the bank, or the loan. There's a question also, in fact, on this, the whole question, if you want to go through, you can go through page 370 from 70. The question starts. And the answer is still page 100 and 375. You can go through it if you want. Now let's go to reorganization. So we are done with business reconstruction. Now we are going into reorganization. What is business reorganization? Business reorganization consists of two things. One is portfolio restructuring, the other one is organizational restructuring. What is portfolio restructuring? Portfolio restructuring consists of changes in the mix of assets owned by firm or the lines of business, right? It means one way, okay, a portfolio restructuring is unbundling. One form of portfolio restructuring is unbundling. We all know what is bundling, right? Those packages and all. You must have heard about those internet packages and all, where you get as a package, right? Two, three facilities combined in one. That is known as bundling. Unbundling. Now you are unbundling. So what is unbundling? It's like you're disposing, you're selling off your subsidiary or some division which is not performing well. So that is a way of a portfolio restructuring. One way is unbundling. There are forms of unbundling. These are the four forms. First is divestment, demerger, sell off, management buyout versus management buy in, right? MB or MBI. I have explained all this in a video. I have created a separate video on each of this. There were four separate videos on each. You can go through those videos and check what it means, right? They all are not the same. They are different ways of unbundling, right? You need to know all. And also you need to know what are the advantages and disadvantages of each. Next, we go to the venture capitalists. Whenever reorganization comes into place, especially management buyout, right? Venture capitalist we have to talk about. Whenever MBOs or management buyout comes into the picture, venture capitalists automatically will pop out. Why is that? Because for MBOs, venture capital is one of the important sources of financial backing. What is management buyout or management buy-in? Okay, let me briefly describe again. Management buyout is purchase of all or part of a business by its manager, the manager who is inside that business. Management buy-in is the difference is, right? It is outside managers who are buying the company, who are taking over that company, right? So buy-in is outside managers, outside that business. Buy-out is the management is inside the business. They are buying part. It could be a part of a business or all of the business. Okay. So that is the difference between management buyout and buy-in. You need to know the advantages and disadvantages of both. But mostly when it comes to management buyout, venture capitalist is must, because it is one of the main source of financial backing. So under venture capitalists, we need to know what are the roles of venture capitalists. From your early studies, you know what are the venture capitalist roles, right? They provide finance, right? And there are many roles, you can go through it. Exit strategies, also they have some exit strategies, right? They don't stay in business for long term, they exit. They stay for a short time, invest, get their amount, and they go off, they exit, and they go and invest in some other country. So that is their policy. They exit, keeps exiting, because exiting is not very difficult for them. Next, how likely is MBO to succeed? You need to know how likely can MBO succeed, right? For example, you can say an MBO is likely to succeed if, right, if, because you can there are few reasons. It could be maybe personal motivation is there, determination is there, or quicker decision making and more flexible. You can see that management is quicker in making decision and they are more flexible, right? They are saving their overheads, right? In this ways, the MBO is likely to succeed. How should an institutional investor evaluate buyout? This is also important, how an institutional investor should evaluate that buyout. So they are just not going to pay you, they are not just going to finance, right? Even in venture capitalist, if they finance for you, they finance for the venture MBOs, they are just not going to finance. They need to see certain things before they finance, before they decide whether they have to finance or not. What are those? They will see whether the management has all the skills, whether they have the right experience, are they committed. They will see why that company is for sale, why are they selling it to the management, what are the reasons. Are they having any loss making subsidiary which they want to get rid of? Are there evidence of that, that after management will buy the company it becomes profitable? What are the projected profits and cash flows of the business after the management takes out, right? What is the price? Is the price too high? Is it too low? What are the exit rows? How are they going to exit if they have to take? And what are the financial contributions, right? Management team can make. So all these things, all these questions need to be answered first. Then it need to be satisfied, that they need to be convinced. Then only venture capitalists will come into the picture, or an institution investor will come and start financing the managers, the management team. Otherwise, they will not. If they feel that any of it's not satisfied, they will not. So the questions you need to know, what are the questions could be. Because when you have to evaluate, when you have to recommend how they should evaluate, or whether they should finance or not, whether the venture capitalist should finance a MBA or not, you should be able to answer these points, right? And there could be a problems with buyout also. Those problems also you need to talk about. You need to know what are the problems in buyout. Then finally, we come to the unbundling and the firm value. Unbundling, right? Divestment, demerger, sell off, all these things are going to affect the firm value. Same way how it has affected, right? How the financial reconstruction affects the firm value, even unbundling can affect the firm value. Effect is on the growth rate. Use the Gordon formula, right? Next. So that's it for reconstructions and mergers and acquisitions and reconstructions and reorganizations. We have successfully finished the two sections, and now the last section of the syllabus, section E. So upcoming next is risk management and exam techniques, right? I might combine this into this two in one video, or this might be in two separate videos, right? Risk management in one video, exam techniques, depending on the length of the risk management video, how long it goes. I can't tell now because I haven't prepared on it. I'm preparing on it now. So in few hours you will get the video on risk management, and then also in exam techniques, which will be part 3 to this. So make sure that you stay tuned to my videos, and if you haven't subscribed to my channel, this is the right time that you should subscribe to my channel, right? So that you get all the information as quickly as possible. Till then, see you, take care, best of luck.